Welcome to the February 2025 Market Update and Roth Conversion Part 3. My name is Kimberly Krug. I am the Operations Manager, and with me today is Daniel Krug, CEO, Senior Wealth Manager. We want to thank City National Rockdale for the research and materials provided in this presentation. So Dan, I've been seeing a lot about tariffs in the news today. Can you tell me what's going on?
Well, there's been a lot of headlines. There's no doubt about it. And the fact is there's a lot of hype out there. The question is, as an investor, you're trying to decipher what is hype and what is kind of something you can look at and utilize as information to invest in the future. So let's talk a little bit about what's going on with those headlines and give people a little bit of insight of what we're seeing and how we see things playing out. Okay, let's take a look at what's going on out there between President Trump and the tariffs. First, Trump recently announced new tariffs on China, Canada, Mexico, but there's already been shifts in it. In other words, everybody remembers, and what the headlines are saying is that they're going to put 25% tariffs on each one of these countries. And what we're finding is that, first of all, with Canada and Mexico, they're certainly negotiating short-term delays while Canada and Mexico are making commitments to the border security and drug enforcement efforts. Now, this is a real big deal. And again, if you think about what President Trump is trying to do, he's trying to hit things on two fronts. One, get the border closed up, stop the drugs and illegal aliens from coming in, and get fair trade on the books. What all the hype that you're hearing out there is doing is it's playing into what President Trump is trying to do, and that is get people to the negotiating table so we can make a fair deal with them. And if you think about China, there is news out there, you do see it. China has responded with its own tariffs and signaling that it could be really an ongoing battle when it comes to tariffs. Now, the question is will that happen? Let's face it, China's got its own problems over there, and they're battling, if you will, economic wars on major fronts. And then while the immediate effects are still unfolding, we know that supply chains, inflation, and corporate margins all are going to be impacted by this. The question is how's it going to play out? And what we all need to do as investors at this point is adopt a wait and see attitude. Because until this starts playing out, we're really not sure which direction we should go. And it would be prudent to just give him time, give the news time to cycle through. Then we can see exactly which direction we need to go from an investment standpoint. So that's Trump and the tariffs. Let's talk a little bit about the economic speedometers for February 2025. So you can see on this screen, you've got November of 2024, which was the last time we got together on these speedometers, and now you got February 2025. There's really only been two changes here, the U.S. economic outlook and energy costs. We're going to hit the U.S. economic outlook first. Now, there has been improvement, and some of the reasons they're improving are because job growth still remains solid. One of the reasons the Fed is not getting the clear signal to reduce rates is because the job growth is still there. It's not going down as fast as he would anticipate or would like to see it in order to lower rates. The other factor here is wage growth is very steady. It's helping boost the U.S. economic outlook right now. Now, on top of that, from an inflation standpoint, though there are still concerns, it's moving in the right direction. Again, not as fast as Powell would like to see it, but you got to really look at it kind of like losing weight. If you're trying to lose weight, your weight doesn't go down on a straight diagonal to the point where you want it to go. What you'll see is it looks more like a bit of a bull market or a bear market where it goes down a little bit, goes up a little bit, goes down more, goes up a little bit, goes down more. But the key is that it's going down over time. And that's what's happening with inflation right now. Then you look at consumer spending. It continues to support the economy. And remember that 70% of the economy is the consumer. So if people are still feeling very good about their income, if the job growth is still there, that's going to help continue to spur on the economy. Then you've got corporate earnings, which are really reflecting strength. And to that end, you got to think about what the current administration has made very clear, that they are a business-friendly administration. They want their policies and their priorities to be businesses. And that, again, bodes well for corporate earnings and reflecting strength, because part of the corporate earnings is based on where the companies believe their profits are going to be in the future, where their revenues are going to be in the future. And based on the administration's policies, they're seeing some pretty good trajectory out there right now. Now let's switch over to the energy costs. Again, this is another dial that has improved, and with it, still in the neutral area, but it's getting closer to green. So energy costs. First of all, the shifting policies, supply dynamics, and geopolitical factors are certainly playing a part in the energy cost. We all know that President Trump, during the elections, was running on a platform of bringing energy dominance back to the United States. So we're already starting to feel that, and we are going to be seeing it more so in the future, very similar that we did in his first administration. Second, in a recent speech at Davos, President Trump directly called out Saudi Arabia and OPEC to bring down oil prices. And really, it is kind of in their best interest, because they're competing against Russia. So bringing oil prices down when Russia really cannot afford to do that is actually going to bode well for them as well as the United States. Now, what does this mean for investors? Well, you may see some volatility that's relative to anything in the energy sector. Prices aren't likely to spike dramatically. That's just not something that happened a lot in the first administration. And lower energy prices could be helpful on the inflationary front. And it certainly is going to help drive economic momentum. I mean, think about it. All businesses, and to some degree families, run on some sort of energy. And when energy costs get lower, what happens? Well, at the end of the day, we have more money to spend. So it's been a lot of news coming out. I mean, just a plethora of news coming out. And I think we're going to get a whole lot more coming down the road here. Kind of an exciting time. And I understand, when you're looking at it from both sides of the political track, there are people that are concerned. I really don't think they need to be concerned, but we have to just let this thing play out and see how things go. So let's move over to Roth conversions. Now, this is part 3 of our Roth conversion series. And on this series, the question is, when is the best time to convert an IRA to a Roth? Well, let's take a look at this. What you have here is a chart. This chart is of the Dow Jones Industrial Average, and it runs from 2019, actually, to end of 2024. And what I'm going to demonstrate here is what was the prevailing strategy that our firm has implemented on Roth conversions. Well, Kim, when it comes to Roth conversions in the past, we've always done them at some kind of dip in the market, right? Trying to take a strategic stance at, converting low and then growing those assets up tax-free. The issue with that is what? We don't know when the dip's coming, right?
Timing.
It's timing. It's trying to make those dips. And if you're get in that dip, that's fantastic, and you really do win at that point. But what if a dip doesn't come? I guess we can look at 2024, right? We were expecting a dip in the market. Kim, did the dip come?
No, we had to do them all at the end of the year.
Yeah, we had to do it all at the end of the year. And that's logistically kind of a challenge there, because, we all get notices from the custodian saying, hey, if you want to make changes, do it in November. Don't do it in December, because we're going to be flooded. And we kind of flooded them in December with Roth conversions. So historically, we've looked at dips. Whenever we got a dip, we would take advantage of that dip in the market. But I'm gonna do a shout out to Arden, because Arden, during a meeting last year, brought up a white paper that he was looking at and a concept of strictly doing Roth conversions at the beginning of the year. So what did we do? Well, you know what? We may not know everything, but if we get a good plan or a good strategy, we're going to research it and we're going to implement if it is a good strategy. And in this case, what we found, it makes a lot of sense. So how does that new strategy work? Well, first of all, what we found is that converting in January, you have a much greater success at going in low and coming out high at the end of the year. Take a look at this. If we did a Roth conversion every January for clients, there is only 1 year out of the last 6 where the stock market was actually down during the year that we did the conversion. Well, I don't know about you, but in my book, that's a big win. Because even with the conversion we did in the down year, the market still was up 2 years later. So it still ended up being a win. This strategy is a strategy we're going to employ moving forward. Now, again, 5 out of the last 6 years ended up. So let's go a step further. Are there other times in the market cycle that are also advantageous to do a conversion? Well, the answer to that is yes. Now, when you look at these 6 years, there's actually 3 additional opportune times to do Roth conversion. In other words, even if you did a Roth conversion at the beginning of the year, you could actually take advantage of doing an additional conversion at a much better inflection point and win on both sides. Yeah, I guess you could look at it, Kim, like dollar cost averaging, right?
Right.
It makes sense in this scenario. Doing it on dips is a very good thing to do. Now, looking at the exceptions of the rule, again, we know there's always exceptions. The first one we talked about was the dip in the market. The second, as you can see, the arrows moved over to December. Now, why did they do that? Well, because if you are actually prone to fluctuating capital gains, and I'm talking about some big capital gains, could be 25, could be 50, could be $100,000 in capital gains that you could get at any given year, then you're probably going to want to do the Roth conversion in December. Why? Because you're going to have a better understanding of what your capital gains are for that year before you pull the trigger on the Roth conversion. And that will help keep you within the targeted bracket that you want to stay in. So it's very important with these strategies to understand that, yes, January is the best. The exceptions are going to be dips in the market and if you're prone to large capital gains. And I would also have to say that if you are prone to a lot of large capital gains, it really does make sense to get into one of our white glove programs with City National Rockdale, Clark Capital, William Blair, where we can actually better control your capital gains. And in the event that you have a lot that could be executed and we need to delay them, we can certainly do that through our white glove program. That's really the biggest thing when it comes to capital gains. There are strategies, right?
Right.
We've seen our strategies in the past work very well, and we've missed the boat on an occasion, right?
Right.
Well, I think the new strategy is going to keep us more on target, and it'll actually work out much better for clients. So again, thank you, Arden, for bringing that information, because I think it's very helpful. And you know what? That's pretty much it on the Roth side of it. Let's take a look at the screen again. We're going to be on YouTube with this information. So the best way to get there is go to mydkna.com, click on Watch Us, then click on DKNA YouTube, and it will take you directly to our YouTube site. There is a plethora of information there that you can kind of glean on. We've got full run videos, and then we've got snackables if you just want to look at a small clip in a specific strategy. Kim, I think that's pretty much it. As we always say, you take care of your family and we will take care of you. We're ready for 2025 and beyond.